Hello and welcome back. Paul Gerard from Price Accounting Services. Today's session we're going to be discussing deductions for 2017 tax, labels D7, D8. That's the dividend deductions and interest deductions. So what are the typical sort of expenses that we're going to be looking at for these two areas? Okay, look, I think we best start off by saying quite often investors have both, okay? So sometimes it's a case of you might claim all the deductions at one label or the other, and it's really a case of being a bit reasonable about that. You might apportion it, but for example, if let's say you had $10 of interest deductions, you're asking to be audited if you go and throw all the interest deductions all into the interest deductions label when the bulk of your income comes from dividends. So watch that. Key issues. Okay, interest acquired to purchase an investment is deductible where the funds are used to produce income. So we've got to be really cautious about the instance where an investor might seek to buy shares with the intention of producing a profit from them in due course. That's going to taint your whole deduction. It is not deductible, but that portion of the interest may well be a capital cost associated with the CGT, profit or loss arising from that asset. So important distinction there. It's one of the reasons why I often recommend to clients, if you are going to be an investor in a portfolio of income producing investments, that you keep that loan distinct. So it's only used for that purpose. And one of the easier ways to do that is with a margin lending facility, because the margin lending facility is almost managed by the financier in the way that you want for tax purposes. So as you buy the investments, they charge you interest, and as you sell the investments and sell them down and repay the loan, it's all automated. So that's kind of pretty straightforward for claiming an interest deduction, because the types of shares the margin lending facility allow you to buy aren't necessarily sold for a profit or loss. Now, what do I mean by that? Okay, a person who invests in, let's say, Commonwealth Bank shares because you want the yield and you produce some income from it, and you'll claim your dividend deductions for your interest, etc. That's all pretty vanilla. Now, you sell those Commonwealth Bank shares, they're going to produce a profit or a loss. Now, provided those shares were acquired to produce income, that doesn't tarnish your deduction, okay? So that's an important distinction. So there's a lot of traps to this. I always suggest, if you're not sure, your advisor's probably going to be the one to guide you, but just make some reasonable allowances and deductions. What other types of costs you're going to have? You might have publications, subscriptions to, say, a data feed with stock exchange pricing, all these sorts of things where the shares are required to produce income, or the interest, will be deductible. I come back to interest deductions. It can be a little bit harder to claim deductions there, because generally speaking, interest is a passively earned form of income. So it's pretty hard to turn around and say, well, I've used a computer and I've used data from the internet, etc., and all you've done is basically take out a term deposit. You know, get your proportions right and make sure it's a reasonable deduction for what you're seeking to claim. Seminars. Now, from time to time, we do encounter people who say, I've attended a Spruker seminar, a seminar that might be an education type seminar, often mass marketed. Question is that tax deductible? Well, possibly not. The intention for the course, and we come back to a self-education in a degree, the self-education relating to investment, you already have to have the investments. You can't go and do a course learning about how to trade shares, and I say trade shares, not invest, and then seek to claim that as an interest and dividend deduction. Not going to fly. It's more capital in nature, because it's really seeking to educate you in how to do something. It's like a preliminary course under the self-education expenses is non-deductible. So take care with that, and I do recommend, if you do such a course, provide the invoice and have a discussion with your tax advisor. It's going to be the safest way to progress with those sorts of claims. So I hope that's given you some sort of guidance. You'll have a myriad of costs. Best way to do it, summarise them, provide them in our annual checklist, and we can discuss the nature of what you're doing, etc. Pretty easy to give advice on those sorts of issues. So until we see you on the next session, it's Paul Gerard from Price Accounting. See you later. Bye.